why didn't my financial planner tell me about this, years ago if it's so good? If you can't make money selling it and you can make money selling something else, you're probably going to sell something else. There's still a stigma that it's some sort of like back alley thug type, if the borrower doesn't pay, somebody goes and breaks their leg. I mean, there's none of that. People don't know what they don't know is the point.
This is The Wealthy Lender, Episode 9. I'm here with Chris Nichilo, founder of Magnetic Capital Group, and today we'll be talking about why your portfolio manager won't recommend private lending.
Yeah, you know what? I have to say, it's not that they necessarily won't. I guess they won't. In most cases, they won't, but they can't, or it doesn't make sense for them to, because in Ontario, and this is important, the private mortgage is regulated separately from the securities space, right?
Yeah.
So we've got the Financial Services Regulatory Authority that oversees mortgages. And so if you're a licensed financial planner, you may not have any way to sell it.
If you're
not licensed
independent.
to sell it.
Right.
Now, there are some securities vehicles that are pooled vehicles that include private mortgages, no question. So you can access it that way. But if you don't want to be in a pooled vehicle, right? If you like the fact that with a private mortgage that you do on your own or you do through a syndicate, you have your name on title, if that matters to you, right? So you're connected directly to the collateral. And that really should matter. Unless you know very well the fund, who's running the fund, who's managing the mortgages, who's administering, who's doing, right? Who's party to it all.
Yeah.
I think that's very important in a pooled vehicle. But, it may be, when you go in and you talk to a financial planner, it's funny how many investors over the years have said to me, why didn't my financial planner tell me about this, years ago if it's so good?
Right.
And for the most part, it's just a lack of awareness or an inability to sell it. If you can't make money selling it and you can make money selling something else, you're probably going to sell something else. I mean, it's not
the ones that work for banks or financial institutions, like I get it, but the independent ones that just have flat fees and don't go off commissions. Have you heard of any independent financial planners or wealth managers that recommend private lending?
Well, no. I mean, unless they have, I don't think you're able to have both licenses. If you are, very few do.
Okay.
You have to choose.
And you mentioned the pooled vehicles, so you're talking about like publicly traded mix, for example?
Yeah, mix, REITs, any kind of real estate based pooled vehicle.
Okay.
So so think about the effect of that though. Like, where do most people go for investment advice? They don't go to a mortgage broker. They go to their bank.
Yeah, bank.
They go to their bank or they go to a financial planner or a wealth manager, financial advisor, multiple names. That's where they go. And so if private mortgages don't come up in the conversation, you just wouldn't know what you didn't know. And so there is a general lack of awareness. Now, I will say I've noticed in the past, 5 to 10 years, more people are getting involved in private mortgages, but there's still a stigma around it, right? There's still a stigma that it's some sort of like back alley, thug type game where, if the borrower doesn't pay, somebody goes and breaks their leg. I mean, there's none of that. It's private, which means it's not as heavily regulated as a bank or a financial institution, but there's still rules, and a lot of them, right? And the Financial Services Regulatory Authority oversees that and monitors it. So people don't know what they don't know is the point.
Yeah.
It's
Oh,
funny, like, and when it comes to recommending, it's like, why would you expect to walk into TD Bank and have the advisor tell you about RBC products?
right.
Right?
Oh, it's a
Like,
very commission heavy space for sure. It's like front loads fees and MER and all that. Yeah.
yeah, and I mean, like, a financial advisor is probably not an expert in everything that's out there. There's so much that's out there. I mean, everybody's working in their little box, right?
Hmm.
So when you go to a bank, that is the box. Everybody in the bank is selling that bank's products. So you're getting financial advice, but it's limited to this box of products.
Yeah. And if the perceived risk is, having to chase your money and people, you're letting someone 100K and they just like take off with it. If that's the initial reaction, then you don't want to be tacking your name onto that or recommending it if you don't even know what it is.
Exactly. You know? And so, but the point I'm trying to get at is that it's not to be, you know, it's not to be controversial with financial planners. A lot of great financial planners out there, but they all have their suite of products that they know, that they trust. And what they're trying to do for you is provide the best combination of those products to suit you and your circumstances and your needs and your ambitions,
Hmm.
right?
Yeah.
So when you start looking at it that way, you say, oh, so I have a responsibility to talk to multiple sources if I want to be exposed to everything or as much as possible that's available in the market. If I go to one financial planner or I step into one bank and I get all my advice there, it's not that the advice is bad. It's just that you have to know going in, it's limited. You're not hearing about anything that bank doesn't sell or anything that financial advisor doesn't have access to.
Right.
So the question to like, if I'm giving sort of advice to a person who wants to invest, I would say keep your eyes open. Look look at everything, right? And compare, you know. So and understand that a portfolio is broken into several parts. And certain parts are designed for certain things. There's a part of the portfolio that it's okay to take some really high risk. Funny, really great story, actually. So I'm talking to someone just the other day about the lottery. Okay. This is so relevant. Uh, so I rarely play the lottery, but I went to the gas station to get gas the other day, and the guy in front of me bought a bunch of lottery tickets, and I was like, man, maybe I should buy some lottery tickets too. So I asked these questions about how the tickets are done, and I learned you can buy them in, basically whatever increment you want. And the Lotto Max for tonight, the draw is for $55 million. So I was like, I'll spend $25 and see what happens. And then she said, "Do you want Encore?" I said, "Sure." This was another dollar, $26. So I'm driving away. I'm thinking for $26, I got, I don't know the exact number, it was something like 15 different sets of numbers, right? Or maybe it's 20. Yeah, I think 20 or 25 sets of numbers. And I thought to myself, if I made this investment every week, call it $25 for easy math, right? That's about $100 a month. It's $1,200 a year. So for $1,200 a year, what percentage of my total income is that? What percentage of my total income would it represent if I spent this much every week for the rest of my life for the chance to win on any one of these millions and millions of dollars? And my thinking went, well, what would be a reasonable percentage of your portfolio to invest in something so high risk and so likely to fail, to produce nothing, right? Like, you might play your whole life and you never win. That's very possible, right? So, but if it hits, it's the greatest investment you ever made by millions and millions of times over.
Right.
So if I said to you, what if you took 1%? 1% of your earnings every year, and that's what goes to lottery tickets. Each one with the potential to win you millions and millions of dollars, tens of millions, right? If I said 1%, you put that aside. How is that not a good investment? It really is. I mean, like it's likely a loss that you can accept easily, and it scales for anybody, no matter what your income is. You buy less tickets. If you're making less money, then you have less budget. But 1%. So if you're making $100,000, $1,000 a year goes to lottery. Divide by 12, you get, I don't know, I think $86 a month, right? So $25 a week or $20 a week, $22 a week, $21 a week. But that's your lottery budget. And then you just invest with peace of mind, knowing that's what the likely result is. But if it hits, you're huge. So anyways, back to, I kind of got off the thing, but the point is that people will only recommend what they're aware of. And it's your job as the investor. This is a problem in our space that people, blindly trust somebody thinking that person knows better than me. They'll take care of it. I'll be okay. I mean, we should take a greater interest in our own money. So when we're going to invest, you might talk to 4, 5, 6, 10 financial advisors and see how they all line up, or when it's that important, right? And then, then you find out about something like private mortgages. And the question that you're asking shouldn't be, how have I never heard of this before? In the sense that it's negative, like I've never heard of this before, so it must be bad. Instead, we ought to look at it and go, what is this? And is it possible that this was under my nose all this time, and just the people I've associated with didn't know about it, or weren't a part of it, or weren't involved in it, and so therefore never introduced me to it?
Outside of the stigma, why do you think more people have not heard about private lending versus traditional security?
Well, where would you hear about it? If you
Well,
didn't know somebody,
everyone's got a
or
relative who got declined by the bank and got some form of financing. And then you
okay,
hear like,
what's
oh, 15%. Well, someone's banking on that, and then you go down the rabbit hole. And
yeah, sure, we all have. Come on, we all have somebody we know that likely has had that experience, but that's not what we talk about when we get together. People don't share that stuff. Like,
that's true.
you don't just right. You don't just be like, I got declined at the bank for a mortgage today. That sucks. Like it maybe does come out with some people, but not most. And the reality is it's not like there's a Walmart around there, like in the mortgage space, that everybody knows. There's no brand of private mortgage lender that is so well known that, you'd be hearing about it all the time and whatnot.
Where I heard about it before becoming an investor with Magnetic was it was an entrepreneurial community, and then one of the posts was, do you want to make 14% on your money? But he was doing it himself. And he said, guys, before contacting a broker, make sure you got at least $250,000 so that you're taken seriously. So then right away I realized, like, okay, well, this is obviously exclusive if you're doing it yourself. But the pooled vehicle, I don't know why that wouldn't be spread around more.
Well, I mean, I think you're probably right that more people know a MIC, for example, than they do know like a mortgage administrator or someone who like runs it all. But people don't know enough about MICs. So even if they know one, they're not really sure on how it works. And it can be very complicated if you go on a MIC website, once you get into the paperwork and stuff, it can be, you have to uncomplicate it as the service provider. It's right. So it's, I think partly it's just not popularized. It's just not, like I said, there's no one or two entities that represent it so well that, Yeah, but so that opportunity still exists. That's one of the gaps we're trying to fill in the market, is becoming so well known for track record.
Mix became kind of popularized in the mainstream in 2022, but that was because the drop in home values caused gated funds for investors, and people couldn't take their money out.
That's a
So,
reality of that's a re
uh,
that's a reality of private mortgages. Now, listen, a lot of what you heard about, the worst cases for those are typically mixed who are maybe a little over leveraged, and so not, you know, the way to stay not over leveraged is to have high volume of mortgages, smaller mortgages,
okay.
and the way to avoid, problems, liquidity problems on the investor side, is to avoid having one or two investors that are such a big part of like a piece of the pool, that if they pull their monies out, it creates a liquidity problem for the MIC. So
Having built such a good model around syndication, what made you expand to pooled vehicles?
pooled vehicles are just another entry point. So for us, what we're looking at is saying, how can we help the financial planning world access what we do, our product, right? Because we've got a long enough track record of running a clean book, and that demonstrates we know how to do that. And so now accessibility becomes possible, right? Like for like accessibility options become required. That's what I wanted to say. You have a certain amount we can grow every year, and we know the inventory will be there, high quality, keep the same, right? We don't like it. Problem with anything investment related is if it's a good thing at this size, it doesn't mean it's a great thing at this size. You have to determine that as you go, and you have to get there at a pace. Because if you're doing so well and you tell everybody and they go, everybody wants in, now you're gonna have too much money, and you're gonna be trying to find the high quality stuff you had before, but they're out of balance. And if they're out of balance, you might end up, instead of investing all that money in gold, you might have to, or feel pressure to invest some of it in silver that could be gold but isn't really, right? And so
Is that what you mean
now
when you say clean book? What is a clean book exactly, like
clean book
technically?
is, have you proved that you can find borrowers, sort them well into strong and weak, have the courage to decline like a high percentage of what you see, and then of the ones you fund, have you proven that your agreement is strong enough, it survives the tests of borrowers, lawyers, poking holes at it, that it protects you, that these are all things that are very important to sustainability. Look, the good news is this: you can be pretty sloppy in private mortgages, and the collateral will bail you out.
Yeah.
So, but it'll be bumpy, right? And so understanding how to do things a certain way is paramount to your survival. And once you can prove that, then it's time to open doorways to bring the necessary capital in. So every year we have room to grow a certain percentage. And we've determined that we can grow at that pace, and there's enough opportunity for high quality mortgages for us to fund with the new money, and fund new mortgages with the old money, the money that's being paid back from existing mortgages. So, once you get there, then the question is, where are you going to find that money? So for us, it's largely through a small network of very, very good wealth managers, right? And so the pooled vehicle gives them accessibility. So it puts a fund, private fund, it makes it accessible to them, and they can bring their clients in for a specific percentage of their portfolios designed for predictability, consistency, and a rate of return that's better than a GIC by 50 to 100%. So your pooled vehicle has just become a doorway. So now when you as an investor find out about us, you may find out about us through the wealth management group, but you may also find out about us by watching one of these videos, or somebody. And so when that happens, we don't know who you are or what's best for you, but I do know that there are different ways to participate with us in private mortgages, and there are different um, risk tolerances and demographics that sort of dictate how you ought to participate in private mortgages safely. And so if we determine, for example, that you want to invest with registered funds through the syndicate channel may make you a higher yield, but the cost that the trustee imposes, Olympia Trust, to manage the account for you in a private mortgage brings the yield down significantly in a lot of cases, to where a pooled fund paying a specific fixed rate per year allows you to avoid a ton of fees with the trustee, because it's a one-time purchase of shares and a one-time exit. Whereas when you're in syndicate, you're buying into a mortgage, it's discharging, they're charging you a fee on the way in, a fee on the way out, and a fee every month plus an annual fee. In the pooled vehicle, you're just being charged one small fee to buy the shares, one small fee to sell the shares. And so actually on an annual basis, you would do better. You'd make more money net at the end by participating through a pooled vehicle.
Does a pooled vehicle, is that only firsts, or?
We're going to have two of them. One of them will only be first position mortgages to 65% of the value. Ironclad, can't do better than that security wise in a private mortgage, and you're still going to earn 6 to 7% return. I mean,
What's the incentive for the syndicate model at this point then?
The syndicate model is fantastic for people who have enough money to fund a mortgage on their own, or have or multiple mortgage, like build a portfolio. Someone who's like a 7-figure cash investor, corporate cash, really good for the syndicate side. Also a smaller investor who wants to invest more than the security side will allow them, because they're not accredited.
Right. Okay.
And then also a type of investor who's maybe a little bit younger, has a smaller portfolio, and requires a higher yield, because we can generate a higher yield without taking additional risk through the syndicate model by creating split mortgages, splitting pieces of mortgages off and changing the priority. So you can give one investor a little more security and a little less return, and the other a little less security, but still great, and a premium return. And when people have a smaller portfolio and they're younger, they can afford to take a little bit more risk and get the higher return. So it feeds itself. It's symbiotic.
So it has to be during a season where you're getting a lot of 10s and 11s, and then you're feeding those to investors who want 10s and 11s, but then you end up having that.
There's no shortage of 10s and 11s. There's no shortage of second mortgages out there. That's what those are. You just need to know where to find them, and where to find the highest quality ones, and when we do. So yeah, you have a lot of those. But listen, through a split mortgage, okay, just to give you like easy math. So if we charge 9% on $100,000, that's $9,000. Okay. if that mortgage is 75% of the value, and there was two investors for 50,000 each, and one was 79, 80 years old, and just wanted to have really great comfort and security, and she didn't need 9%. She could be happy at, let's call it 6. Okay, so we give her the piece of that mortgage that represents 50% loan to value. Okay, and we pay her 6. Well, now we can take the investor who goes into 75% of the value and takes that back piece. And basically what they're saying is, if only 50,000 comes back, it all goes to her.
Right.
But if the whole 100 comes back, I get paid too. And my exposure is only 75% of the value. So I feel pretty good. Well, I'm now earning 12. I'm earning the 3 that she gave up on top of my.
I see. I see. Okay.
So you can create, by administering well, you can create pieces of mortgages and satisfy different appetites. You can't do that in a pooled vehicle. It has to be the same no matter what. So we're creating 2 pooled vehicles.
Is that currently available in the syndicate model?
What?
Getting 12 where the other participant gets less because you.
No, it's coming. It's coming. It's coming. Yeah, it's coming.
I was like, wait, I was like, wait, I haven't heard of this.
That piece we have done in the past when, like, on a one-off, but what we realize is, by the way, the key is finding the people who want the uber security piece of, let's say under 65% loan to value, right? And are willing to take 6 or 6.5 or 7. That's the key. And there's lots of those people out there. I mean, and why wouldn't there be? I mean, if you're the type of person that worries about losing, you put that money, you got $1 million, you don't want to lose it, and you don't want to put it in a GIC because it only pays like 3.5 or 3.2. And I come along and I go, how about 65% of the value against the property, and you make 6.5.
Mm-hmm.
And you go, so I make $65,000 a year, over $5,000 a month, and my exposure, my chance of there being a real problem is
6,500. You mean?
No, if you have $1 million,
okay, $1 million. Okay, I thought we were doing the 100K example. Yeah, $1 million.
No, you're making 65 grand. So if 65 grand, you own your house, you own your car, you got 5 grand coming in every month, plus your old age pension or your whatever pension you have, you're killing it, right? And you're never losing sleep. Well, what that's doing is allowing somebody else to make maybe 9.5 or 10 or even 11 on a mortgage that the borrower was only paying 9. It's all proportion math, right? So the proportions have to all be equal. The example I gave you was perfect proportions, right? 50,000 each, 9% mortgage, one drops 3, one picks up 3. But if the pieces don't all match, there's some wizardry there that we have to do behind the scenes. So anyways, that's the intent, is to be able to do that come 2026.
In a market with the declining home prices, I'd err more on the side of, not doing that, taking 3 that the other one gives up. But in a market where values are appreciating,
I would say I wouldn't look at it as, in this market do this, in that market do that. No, I think it's case by case. Every opportunity is different. There's nothing like the market right now only impacts us if it continues to decline, because any mortgage that we're originating now, it's based on an appraisal of the property today. So when the market starts to level off and you can feel that coming, you get some comfort from that. But anyways, I just wanted to clarify, it really isn't about the market. It's about each deal on its own.
Yeah.
They're all different. They all have hair on them. there's something wrong with all of them.
Yeah.
Wrong, you know? Something
Wrong,
out of the
outside of the
ordinary.
rigid bank.
Yeah, exactly. So they all have some deficiency, perceived deficiency when they come to you. So you have to sort through them, pick through them, find the good ones, and that's why you need to have defined parameters around how much you're trying to raise each year and put out and all the rest of it. Anyways, so end of the day, it's not a lot of times not the financial planner's fault. They just took a job working for a certain company who has a certain suite of products, and private mortgages isn't in them. So, and not only that, firms typically want to keep money in the firm. So you have an account at the firm and your money is invested in these funds, right? To participate in private mortgages, you have to take the money outside the firm, invest it directly in a private mortgage, and report to your customers in a different way. It is logistically a challenge. You know what I mean?
Yeah.
So there's a lot of little things, but awareness is top of the list. That, you know, if you can't sell it, you're probably not aware of it yourself.
Do you get nervous when you see money leaving and you're like, wonder if the next deal, is going to entice them back?
You mean when money gets paid back?
Yeah.
No, it's remarkably high. Or I should say remarkably low, the amount of times somebody takes their money out.
Mm.
I mean, look, it's all just talk right now. But if as you've had this experience, once you have seen a payment coming to you consistently on the 15th of every month, month after month after month, it's like hard for somebody to convince you to stop that and do something different.
Well, that's why I brought it up. I'm like,
Yeah.
it shouldn't make the fund manager nervous that, by the nature of the investment vehicle, if it requires money to exit, if the investor's happy, it shouldn't be a concern.
Yeah.
Okay. Let's leave it at that.
Okay.
All right. On to the
Bye-bye.
next one. Bye-bye.